Full disclosure, as many of you know, 20 plus years ago, I was one of the board members of the Federal Home Loan Bank Board, dealing with the savings and loan debacle of that era of the late 1980s. And as part of my governmental obligation as a board member, I was also a board member of Freddie Mac. When I left government service in August of 1989, I also left the board of Freddie Mac. That was almost 22 years ago, and haven't been back. So, full disclosure. All right, I'm going to be talking about guaranteed to fail. This is, you're going to see a little bit of shameless self-promotion for the book in just a few minutes. This is a joint effort by Matt, by Viral Acharya, who unfortunately couldn't be here today, although he's another guy with 35 hours in his day, and somehow there wasn't enough room. He needed 37 or 38 today, and he just didn't have it, so he couldn't be here today. And Stijn van Neurenberg, we've collaborated on a book with this title, and you'll be hearing a little bit more about that in a minute. I've got to leave. I realize this is now a headline event, and this morning's New York Times couldn't have asked for better timing than this morning's New York Times. Their right-hand front page, the most important story, well, unless you count the Jets losing to the Steelers last night. But after the Jets and Steelers, what's the most important story? Of course, it's always the right-hand column story, and it is mortgage giants leave legal bills to the taxpayers. A mere $160 million of legal bills, but it's Fannie and Freddie right there on the, and this isn't the Washington Post, this is the New York Times. This is not an inside the Beltway issue anymore. All right, now we're talking about mortgage finance, of course, and so I can't not read this to you. The shapers of the American mortgage finance system hoped to achieve the security of government ownership, the integrity of local banking, and the ingenuity of Wall Street. Instead, they got the ingenuity of government, the security of local banking, and the integrity of Wall Street. That was written by David Frum. As many of you know, Mr. Frum was a speechwriter in the early part of the George W. Bush administration. Just, you know, reading words like that, it's clear why he's a speechwriter and I'm not. Now, another important quote from Rick Carnell, who was an assistant secretary of the Treasury in the late Clinton administration. The GSEs play an extraordinarily successful double game, telling Congress and the news media, don't worry, the government is not on the hook, and then turn around and tell Wall Street, don't worry, the government really is on the hook. And sure enough, we are, and that's a big part of the reason why we're here today. And then finally, because this is Washington, I can't not, wait a second, there we go. The famous quote from All the President's Men. Maybe there were people before Hal Holbrook saying, follow the money, but that's clearly where I first learned the phrase. Now here is the shameless self-promotion. As you may have noticed, as you came in the door on your left, there was a poster, there was some flyers. This is a book that Matt and Viral and Stijn and myself have written. It is coming out in about a month and a half by Princeton University Press. Lovely cover. Clearly, this is a book that ought to be judged not only on its content, but on its cover. All right, now, since I am a business school professor, I gotta tell you what I'm gonna say, and then say it, and then tell you what I said. And so I'm gonna provide some background, remind you of the basics of Fannie and Freddie, remind you of the circumstances of the debacle, and then talk a little bit about the way forward. You're gonna be hearing a lot more about the way forward later this morning and then this afternoon. But I want to sort of give you lay the groundwork, give you some background here. So, all right, some background. First, as the congressman reminded us, we're not operating in a vacuum here. There's a rich, and unfortunately way too rich, environment of housing policy with widespread subsidies for constructing and consuming housing. The question related to the mortgage deductibility subsidy, which is the largest of all of these, it's very large, and they are broad brush. They're not especially focused, and Fannie and Freddie subsidy is certainly part of that very broad brush subsidy. And what, at the end of the day, what they really encourage is not so much encouraging home ownership. There's a good story to be told about encouraging home ownership, but instead what they mostly encourage is just buying more house. Buying a house with a 6th bedroom rather than 5 bedrooms, with 4 bathrooms rather than 3, on a half an acre rather than a third of an acre. Where's the social gain in that? And yet that's what these broad brush subsidies end up doing. And what that also means is that we do have too much house. Our housing stock is bigger than would be the case if we didn't have these broad brush subsidies. And the fact that we are putting too much of our nation's capital into a housing stock and not enough in business capital, in social capital, in government capital, means that our GDP is lower than it otherwise would be. Again, home ownership does have value, but what that means is we need to have better, more focused programs, targeted, being careful rather than broad brush. Now, just, you think, but gee, we're getting high rates of home ownership. No, not necessarily. And here I'm lifting, again, I'm going to be shameless all during this presentation, lifting some data that Alex Pollock, who is in the audience here, presented before the Congress a couple of months ago. These are the home ownership rates across the world. And you'll notice that out of 25 countries, the United States is 17th in terms of home ownership rates. Other countries don't have, yes, they have government involvement, but not as extensive, and they certainly don't have the kind of Fannie and Freddie involvement. And yet, a lot of countries do a whole lot better in terms of home ownership rates. Then the last thing as background, just to remind you, during most of our lifetimes, there has been a major revolution in mortgage finance. The old model being the savings and loan, and to some extent commercial bank model of they make the loan, they hold it in portfolio, they do the servicing. Everything is vertically integrated, to use a phrase from industrial organization. But the new model that really grew in the 1980s is a vertically disintegrated model where the originator doesn't hold the loan, it packages it, sells it into a secondary market. There is either the originator or a separate packager. There's a separate investor. There have to be somebody providing some advice about the creditworthiness of the package. It's a whole bunch of separate parties. There are advantages to this model, but as we've learned to our sorrow over the last 3-4 years, there are clearly disadvantages as well. All right, now, and of course Fannie and Freddie are part of this new model. All right, to remind you now of the basics of Fannie and Freddie. They have two primary businesses, or as Frank Raines used to say, it's really a simple business. The two businesses are, were and still are, they issue mortgage-backed securities and provide a guarantee, in return for which they get a guarantee fee. But as we learned, it was too low and they weren't keeping enough of it in reserve. And the second business was investing in, holding in their own portfolio, a package of mortgages. And at the end of the day, they had only approximately 1.5% capital to protect themselves and, in the end, the taxpayer. And it turns out it wasn't enough, only 1.5% capital to protect against the credit risk of the combined mortgage guarantees on the mortgage-backed securities that they've been issuing and the mortgages that they held in portfolio. For those of you who are somewhat of an accounting bent, here is a standardized balance sheet that shows you basically what was going on. If you standardize everything to 100, they had 100 in assets, which were mortgage loans they were holding in portfolio. They borrowed 96 by issuing bonds. They held only 4% capital, net worth, owner's equity on their balance sheet. And so if you just looked at their balance sheet, they looked like they had 4% capital. Even that is pretty thin as compared with what a bank, a savings and loan, would be holding. But in fact, in addition, there was that extra 200 of mortgage-backed securities that they had issued on which they had issued guarantees. And so that 4 was really supposed to protect against losses not only on the 100 that was on the books, but against also the 200 on which they had issued guarantees. And so the leverage wasn't really 25 to 1. It was closer to 70 or 75 to 1. Now, these were very special, and still are, entities, and I'm just going to give you a laundry list. It's not worth spending a lot of time, but though they were publicly traded companies, their stocks were listed on the New York Stock Exchange. They got delisted about a little less than a year ago because they're now a penny stock, but if you want to take a flyer, you can still buy their stock, no longer through the NYSE, but there's just a long laundry list of things that made them very different from every other company that was listed on the NYSE. Here's even more, and so they really were government-sponsored, and still are government-sponsored enterprises. Now, most of those things you would describe as advantages. They also have and had limitations. They could only do mortgage finance. They couldn't originate. They couldn't really expand into any other kind of finance. They were subject to a limit on the size of mortgage. Up until 2008, it was $417,000. Now, in high-cost areas, it's almost double that amount. Those mortgage amounts mean that the mortgages that they can buy or securitize is way above the mortgage on a median value house in most areas. So it isn't just the low end that they've been focusing on, and that's an issue I'm gonna come back to. They were subject to various kinds of regulation, mission regulation by HUD, which basically meant an affordable housing mandate. I'm going to come back to that. And they were subject to, alas, not very effective safety and soundness prudential regulation as well. Now, there was a consequence to all of this. First, the markets treated their debt as agency debt. That phrase first came into play when Fannie really was an agency of the federal government. This is before 1968. They got spun off as a NYSE traded company in 1968. And they were able to borrow in credit markets at approximately 40 basis points, 2/5 of a percentage point less than their credit their financial structure would otherwise have justified. Basically, they were a AA- company, and they were able to borrow at better than AAA rates. Not quite as low as the U.S. government could borrow at, but almost. The further consequences, they passed some of that advantage through on their conforming mortgages that they could buy or securitize, and that meant that mortgages were about 25 basis points less costly, a quarter of a percentage point, than otherwise would have been the case. But you got to ask, given that housing was already heavily subsidized, was this really a worthwhile thing to be doing? And were they really focusing on the area where you would have liked them to have focused, which was the low, moderate, encouraging the first-time home buyer? That's where the real social value would be. But it was part, as I mentioned before, the broad brush subsidy. There was always the issue as they tried to expand their business a little bit. Are they doing it just because they have this borrowing subsidy, or are they doing it because they really are more efficient? No one really had a good answer for that. Just to show you some visual pictures of that 25 basis point advantage. Here's a picture from the California lending market. Bob Van Order, who's at George Washington University, put these pictures together. And you can see the differential between the interest rates on conforming loans and the interest rates on jumbos. And you can see there's this big jump, 25 basis points, between the conforming loans that are below the conforming loan limit and loans that are above. That was for 2002. Come on. There we go. There's 2003, same basic story. Now I'm going to show you another picture put together by Frank Notaft at Freddie Mac, chief economist at Freddie Mac. There you see the interest rates on conforming loans and jumbos up through the summer of 2007. The sort of financial markets fell apart in the summer of 2007 as people realized, oh my gosh, something is happening to all those subprime mortgage and mortgage-backed securities. Bear Stearns started having their difficulties. Some of their hedge funds started going south, and the market sort of fell apart, but up till that point, it was 25 basis points. So that's, that 25 basis point differential, the quarter of a percentage point, is a pretty robust number. Now, in terms of, where were they focusing their efforts? Here, I'm going to show you some pictures, some maps drawn from a chapter by Jonathan Brown in a book edited by Peter Wallison of the American Enterprise Institute of, this is 10 years ago. These are data from the late 1990s. Come on. There we go. All right, this is the Chicago metropolitan area, and dark on this map means Fannie and Freddie are heavily involved in mortgage loans that satisfy the conforming loan limit. Light means they are, on a percentage basis, not very heavily involved. And as you can see, light is toward the center of the Chicago metropolitan area where low, moderate income households would tend to live, and dark is toward the outer suburbs. Where were Fannie and Freddie doing the most business? Out in the outer suburbs, not in the inner areas. This is the Cleveland metropolitan area. It's the same story. And this is Dayton, Ohio, and it's the same story again. Low involvement in the low, moderate income areas, much heavier involvement in the outer areas. And you can understand how, seeing pictures like this, the Department of Housing and Urban Development in the early part of the past decade, early 2000s, started saying, you know, if these guys are getting a subsidy, maybe they ought to be putting more effort into providing finance for low, moderate income households. And so the mandate for doing more for low, moderate income households gets ratcheted up, and there were consequences. Now, let me show you a bit, summarize Fannie and Freddie's growth. As you can see, sort of starting in 1980, they're moderate size, and between 1980 and 1990, there's still only moderate growth. This is a period when Fannie is underwater financially, Freddie Mac is still under the thumb of the Federal Home Loan Bank Board, and there's moderate growth. Then, from 1990 to 2000, much more substantial growth. Fannie has sort of shrugged off the limitations. Freddie has become a publicly traded company, no longer part of the Federal Home Loan Bank Board structure, and both of them are learning the magic of leverage, as well as the magic of issuing a lot more mortgage-backed securities. And then even between 2000 and 2003, there is astonishing growth over the space of just 3 years. Then things slow down, at least in terms of the mortgage portfolio. There were accounting irregularities, first at Freddie in 2003, then at Fannie in 2004. That gave their prudential regulator an excuse to go in, slow down the growth of the portfolio, but it didn't slow down the growth of the mortgage-backed securities issuances because nobody seemed to be worried about credit risk. Everybody was worried about interest rate risk that might be embedded in the portfolio. The interest rate risk on the mortgage-backed securities, that was a problem for the investors. Now, briefly, what were the reasons for the growth? Partly, you know, there really were and are efficiencies to the mortgage-backed securities process, but also there were differential capital requirements. Banks and thrifts needed 4% capital to hold a mortgage, but if they held a Fannie or Freddie mortgage-backed security, they needed to hold only 1.6% capital, and Fannie and Freddie only had to hold 0.45% capital against that mortgage-backed security. So in aggregate, through the securitization process, there was only 2% capital being required rather than 4%. And you know, just like water flows downhill, mortgages will flow to the party that can leverage it the most, that can hold the least amount of capital against it. And so mortgage-backed securities was a lower even though the credit risk was still the same, mortgage-backed security route had less capital. And for the portfolio itself, well, Fannie and Freddie had to only hold 2.5% capital rather than that 4% that banks and thrifts required. Plus, as I just showed you a few slides ago, Fannie and Freddie could borrow cheaper. Once again, mortgages are going to flow to where the leverage is the greatest and the financing costs are the least. All right. Come on. There we go. As most of you know, there was new legislation in 2008. It expanded the conforming loan limit in high-cost areas. It did provide for stronger prudential regulation. I think at that point it was way too late. And it also gave the Treasury the authorization to invest unlimited funds, and the Treasury has used that authority. All right, let me briefly remind you of the debacle, which is why we're here today. By early, you saw that picture a few slides ago of how things start to come apart in 2007, and by early 2008, it's clear there are stormy atmosphere, big waves ahead, and though on a gap basis, Fannie and Freddie looked adequately capitalized in early 2008. The trends were bad. They'd experienced losses in 2007. If you mark them to market, Freddie was underwater by the summer of 2008. Fannie was headed in that direction pretty quickly, and by the end of the summer, the financial markets were really worried. Despite the implicit guarantee, there was real question as to whether Fannie and Freddie could continue to finance themselves, whether they could roll over that debt. And the credit risk dangers were starting to become apparent. Their underwriting, as it turns out, had started to deteriorate even in the 1990s. So they were starting to head downhill even in the 1990s. Around 2003, having lost market share to the subprime securitization process, they decide they've got to get their market share back, and so they go much more heavily into lower quality mortgages. That was going to eventually come back and bite them. Given the general downturn, even prime mortgages, if they were originated in Las Vegas in 2005, 2006, there were going to be some losses there as well. There are they also, to meet their part of their housing mandate, low moderate income housing mandate, they went heavily into buying what appeared to be AAA rated top pieces of mortgage-related securities that have since gone downhill as well. Now, just to, here I'm borrowing from Dwight Jaffe. These are the patterns of defaults on first the Freddie Mac portfolios by year of origination, and you can see they don't look so bad for the earlier years of the decade, but at least partly what's going on there is that the poor underwriting that was going on in the late 1990s, they can get away with it because housing prices continue to go up. Up until 2006. But by the time that the vintage of about 2004 and then for sure 2005 come around, they're goners. That the quality is so bad, and then the default rates just grow. And the story for Fannie is much the same. There's also interest rate risk out there on the portfolio itself, and that really hasn't gone away. We've got the government conservatorship now. Why a conservatorship? Well, the choice was either conservatorship or receivership, and the federal government really didn't want to have to deal with the implications of a receivership. But it's, when you think about the word bailout, I think you want to be really careful because the shareholders are going to be wiped out. Senior management is long gone. If anybody has been bailed out, it is the creditors to these two companies. But gee, that guarantee was basically always there. The current situation, they are in receivership. As the congressman reminded us, over 90% of mortgage originations now are basically going either through Fannie or Freddie or through the FHA Ginnie process. We're reading about losses every quarter, but it's important to remember that those losses are basically the delayed recognition of the bad events of the pre-2008 period. There's been $150 billion that's been invested by the Treasury. That money's gone. Don't expect it to come back. This is not going to be like the TARP. That's basically, those losses are baked in. They could get as big, the congressman said, as big as $360 billion, I think. 400 may be a possibility as well. And total outrage, Dodd-Frank was totally silent. All right, just to give you a little bit of a preview of what you're going to be hearing over the next part of the session. First, there is the issue of housing subsidies. In our book, we argue that they ought to be cut back. Again, we've got too much house out there. we shouldn't be encouraging people to borrow more, even if you think home ownership is a good thing. Encouraging people to leverage themselves excessively isn't a great way to go. And anything we do, it ought to be explicit, it ought to be on budget, it ought to be going through HUD. Next, the mortgage portfolios ought to be shrunk. There's absolutely no reason for these huge $800 billion portfolios of mortgages to be sitting out there in a quasi-private, quasi-public entity. And then the issue of guarantees. Are they needed? How should they be arranged? Should they be nationalized? Is instead a wholly private direction feasible? You heard the congressman. You'll be hearing Dwight Jaffe in a little while talk about that possibility. Or is there some kind of public-private hybrid, which, as many of you know, there have been various proposals in the book, and you'll hear Matt talk more about that in a few minutes. We have what we think is an innovative way to be dealing with a public-private partnership that keeps market discipline there, that gets the pricing a lot better than we think other possibilities. So, in conclusion, it's clear these housing policy, housing finance, GSE issues are difficult. If they were easy, we wouldn't be here this morning. They would have been solved already. They are difficult, but they are truly important. We're talking very big numbers. And stay tuned. So, Lemma, Matt, again, thank you.